Prop firms are not a track record. Now, I'm not saying go and put it all in red and black on every single trade and just sprint it until you pass. No, I'm saying have a plan, be smart about it. But prop firms are not to build track records. They to make money.
If you are new, be very, very patient. Don't go for the biggest accounts, go for smaller accounts. Don't rush for big trade sizes. Don't try to pass as quickly as possible because you're probably just going to end up blowing multiple accounts and wanting to quit or running out of capital. No one has unlimited number of tries. If you are a terrible trader and you don't have a winning strategy and you don't have an edge, you are just going to blow accounts over and over again. What's going on, guys? Welcome back to yet another episode of the Challenge Accepted podcast, and it is our final recording for 2024. Today is December 27th right now for us, and by the time this goes out, we'll be in 2025. So wishing all of you a very happy new year. I hope that you all get to crush your trading goals this year. And I think we'd like to start off the year, I guess, since it is the new year when you see this. I'd like to start off the new year. We'd like to start off the new year with a deep dive into risk management strategies when it comes to trading prop firms. We all know that the prop game, the prop industry is almost like a gamification of trading, right? It is trading. You are still applying your strategies, but because there are prop firm rules and because there are prop firm parameters, a lot of times you are almost playing a game on top of trading your strategy. And if anything, risk management and how you approach risk management within this game is infinitely more important even than when you're trading your own account, because you simply don't have the flexibility of a lot of drawdown, right? You are faced with this brick wall of breaching your challenges. And depending on how you go about approaching your risk management strategy, it can also heavily impact things like your psychology. It can also heavily impact things like your desire to want to trade or your ability to continue trading, right? So I think that there's many different ways to approach this risk management game when it comes to the prop trading side. But I think that in general, there are two main approaches that you can go with. And the first one is going aggressive. I think we've talked about this on stream on other episodes before with James, where he doesn't mind losing challenges because he's got plenty of capital to back up. He wants to get funded as quickly as possible. He's basically cemented his strategy already, right? And he just wants to accumulate capital, right? Across different firms, with Hydra, with FTMO, it doesn't matter, right? He can deploy his capital across, diversify risk that way. So that's one way of approaching it, which we've kind of talked about. And I will have James jump in here and really outline a strategy that can be used for you guys. I really want this episode to be something where you guys can get out of this podcast after watching it and go back and be like, hey, I think that this approach really works for me. Basically come up with a blueprint and say, hey, this is exactly how I want to do it. We want to give you all of the details and how you can approach this and how you can break up your starting capital. All right. So we'll get into the details in a little bit. But the second side of things is you are maybe more of a beginner. You maybe want to play a little bit safer. You don't mind trading challenges for longer, right? You don't mind because maybe you're using it to test out a strategy. And I actually think that prop challenges are an amazing low risk way for you to test out a particular trading strategy. Say you just joined a new group, you're learning from a new mentor, or maybe you've back tested something and you want to deploy the strategy on the live market. We all know that there's tremendous differences between backtesting and deploying on the live market, right? You just don't know because spreads, slippage, commissions, depending on what time frames you trade in, all of these things come into play when they don't matter in backtesting. So maybe you want to figure out, your variance, what that looks like, whether, execution wise, you can even execute on this time frame on the live markets or not, right? I think that using a prop account is a very nice way of forward testing with very, very low risk, especially if you're a new trader or especially if you are looking to deploy a new strategy. And I've done this myself in the past. I started trading prop challenges. Maybe my first one was in 2022, I want to say, my first ever prop challenge. I think I bought it with FTMO. Back then,
Sure.
this was before Hydra existed. And yeah, that was kind of how I viewed it. I viewed it as a way for me to really try and test out a strategy. Back then, FTMO still had a time limit, so I was risking more.
Yeah.
But my approach mentally was, I'm just taking this as a test. It was a small account. I just want to see whether, I can perform on this strategy or not, right? And I had done, a large amount of back testing. And I want to give you my approach here, which is a more conservative one that may be more beginner friendly, that may be more suitable for people that are still feeling their way around. Maybe you're new to prop trading, maybe you're new to trading in general. And I want today's episode to be about bringing you two different sides of the same coin. You're still trying to pass the challenge, right? But very different approaches, very different risk management styles, and probably also different levels of psychological stress and impact. And of
Yep.
course, we're gonna start with the more aggressive one because everyone wants to get that challenge cash, baby. So
Yeah. Let's.
I'll let James take away, go
Yeah.
into
Let.
the details about how the aggressive approach works. And I think I want to start this off with a question for James, which is,
Sure.
uh, if you are taking this aggressive approach, right? Exactly how many percent are you risking per trade? And how do you then prepare yourself on the psychological side, knowing that this higher risk could lead to a higher failure rate?
Yeah, it's going to lead to a higher failure rate. Let me just say that from the get go. I've probably taken like 6 Hydra challenges right now. I haven't passed one yet because I'm being aggressive on them, right? So it is going to lead to a higher failure rate. But then I might have passed some others with other accounts, which I've done the last bit. So I know that when I pass and I get payouts, which I've taken some pretty nice payouts in the last 2 months or so, it's going to make up for the ones that I fail. If that makes sense, right? If I spend $1,000 trying to pass challenges and I get paid out $10,000, well, I made $9,000. So that's what I'm kind of banking on with being the more aggressive strategy. So I can actually share my screen here. So let's get that up. I can actually share my screen and show my current Hydra account challenger that I'm on at the moment. You can see I started at the beginning of December. It's been a little bit of a slower month. I've been, as mentioned, I'm trading quite a lot of individual stock names, which obviously Hydra does not offer individual stocks. I'm mainly trading the DAX, and you can see a little bit of EJ, but I am trading a little bit of the Nikkei and S&P as well. So indexes mainly on this account. I'm up, so 50K account, I'm up 4% on it. Yeah, so it's going along quite nicely. But what I would say, so basically the more aggressive strategy, DY, would basically be, if I'm looking to get a funnel with 50K accounts, I'll buy 5. And if I pass one of them and then and let's just say it cost me $1,000, whatever, $2,000 to get it, I'm banking that when I pass it, I'm going to make more than $2,000 to get my money's back, of course, right? That would be obviously the first thing. The second thing is, a lot of traders, what I used to do back in the past when I was maybe a little bit more conservative, instead of buying a 200K challenge off a bat, buy 4 50K accounts, and you're giving yourself 4 times to pass instead of the 1 time. Now, that obviously for me, I've changed it because I used to buy 200K accounts, but now I'm actually giving myself 4 times to pass. So if I fail 3 times and I pass 1 time, I'm making my money back from that. So that would be the more aggressive approach. And what I try to do, you can actually also see if you go back to my account here, right? We can actually see that I'm trading a lot less, right, on these accounts. So I'm breaking even, but I'm trying to, on some days, but I'm trying to trade less and then swing hard on the bigger days. You can see I'm made like over 2% on this day, and then I lost 1% on this day, 2% on this day. So trying to trade more aggressively on my better setups. That would be more the more aggressive strategy or way of approach.
And the kind of follow up here is, exactly how many percent, I'm sure the guys would love to know, how many percent are you risking per trade setup? Is it a variable risk? Do you have,
Variable
plus setups being 2%? What exactly are some percentages that they can follow, and what challenge parameters would that be more suitable with?
It would definitely be more so. Probably why I've had struggles with the Hydra accounts at the moment is, I was doing the 1-step static drawdown, which had a 6% max loss. Okay, so if you go on Hydra's website, you'll see the 1% has a 6% static drawdown, and then the 2-step has a 9%. So that 3%, little 3%, On a 100K account, that's 3 grand. It's a big difference, right? So I think if you're being more aggressive, probably with Hydra, in my opinion, so far, obviously the industry standard, FTMO has the same, whatever, is the 2-step challenge, right? You got to make 8% with a 9% static drawdown. If you want to be more aggressive, if you want to be a little bit more conservative, which DY will speak about, I would probably recommend the 1-step, because you got to do it once. It's a little bit more conservative. So if you want to be aggressive, I'd try the 2-step for sure. I think it's more favorable for the more aggressive traders. Now, you talked about percentages. I'm doing anything between 2 and 4%, bro. Like if I'm like, okay, this is a nice trade, I'll risk 3-4%. If I fail, I'll buy another one and we'll rotate like that. As long as I'm making more than I'm spending at the end of the day, that's all that really matters. Because prop trading is different to trading personal capital. Will I come in on my personal trading account, let's just say it's got 100 grand, and would I risk 4 or 5%? Probably not, because it's actually you losing 4 or 5 grand. You're not losing a 50K or 100K account that you pay to trade with. And that's what you go back to what you're saying about using prop firms to actually forward test and actually get some skin in the game, or even to make money is quite nice, because you're not actually having to put your own money into a brokerage account. Which, don't get me wrong, I love trading personal capital, but I think prop firms are the best way to leverage yourself in order to grow your personal and private long-term portfolio and brokerage account, everything like that.
Okay, so anywhere from 2 to 4%, even depending on the setup, is kind of what you're looking at for this very aggressive approach, right? So
100%.
think about the math a little bit, I guess, on the 2-step challenge. Definitely, I agree 100%. If you want to go more aggressive on the risk, you want there to be more room to play with. And on the 2-phase challenges, not just for Hydra, but pretty much all prop firms, you get more drawdown. You just get more room to play with. And I would strongly suggest you kind of go for that, because that extra 3% drawdown is going to make a difference. And I'm guessing, based on your trading strategy, if you're risking anywhere from 2 to 4%, it's probably going to take you, if you run good, maybe a 3-4 trade win streak will get you past phase 1, right? 3-4 trades could be past phase 1.
Yeah, because I'm trading 1-to-1, sometimes even less than 1-to-1. It could be maybe 6 days that I could pass on. Maybe I have 3 winning days, 1 losing day, and depends. And then I'll get another 2 winning days. Yeah, it could be.
Yeah. So it sounds like what James is doing, in this aggressive approach is you are willing to essentially eat the short-term variance, right? You're willing to eat, like, okay, I just lost 3 trades in a row. I'm done with this account. It's basically finished. And you're also willing to be on the flip side of that. Hey, if I go on a pretty good streak, I'm done with this challenge in a week. And I don't need to be, and I can be on phase 2, which is even easier to pass, right? Phase 2 has a 5% profit target as opposed to an 8% in phase 1. Phase 2 is essentially the easy part, where if you're deploying this aggressive strategy again, right, and you still have that same 9% drawdown, right, you could lose some more trades and then easily make it back. So a 5% profit target for someone trading a lower RR system like James, risking anywhere from 2 to 4%, he could be done in 2 trades, 2 or 3 trades, and it's not out of the question if you have a good win rate like James, to be able to win 2 trades in a row. I don't think that's really out of the question. He could probably do that day trading, scalping like he does in a day.
Yep.
Right. So you're looking at a time horizon that's very, very short, potentially, for getting that funded account. All right. So before we I do want to talk about, how your approach changes. And I think this is a big key, guys. You guys need to stay and listen to this, because he's not doing this on the funded stage.
No.
Okay?
No.
He's not doing this. Yeah. But before we kind of get into how the switch happens when he gets funded, do you have any advice for some of the viewers who maybe want to take this aggressive strategy? Do you have some advice to on how they can maybe prepare themselves mentally, because the variance is going to be high? As you said, you've probably done 5-6 Hydra challenges, and you're still on I think you're probably on your 6th one, actually, 5th or 6th one. And you're up. This one's looking good, and you failed the other ones relatively quickly, right? It was a very quick kind of band-aid. Do you have some advice to on how they can approach this and how they can kind of handle potentially blowing 3, 4, 5, 6 accounts in a row?
100%. So how I see it is, you got to, in trading, you always, whenever you click a button, you got to be to place a trade. You got to be prepared to lose that whatever you risk, right? So if I click a button to risk 4%, and then I lose 4%, I can't say, oh well, that was a surprise. Or I clicked the button to risk 4%. I knew that it could happen as soon as I hit enter, right? So I'd say, you always, don't be prepared to lose, because you don't know what trades are going to win, what trades are going to lose. And also, if you fail 5, 6 accounts and come back on the 7th account, it just takes one payout to make all those accounts that you lost back, and then you are back on the right track. So I'd say don't give up. That would be my, you got to continue going. I mean, if I could just quit now and say, well, I don't like hydras the way that I'm trading hydra, I'm just going to stop. But then I don't know if I could continue, and I could actually get a really nice payout to them. So with you guys, so you got to just continue. That's what I would say, especially if you are adapting a more aggressive style.
Yeah, and I'd love to reference back to our previous podcast with one of our traders, Sauser, that was the highest payout of the year.
Yeah.
He deployed a very aggressive strategy. He
He
deployed
said he
it
failed a
both
lot.
on the challenge phase as well as with the funded account, because he's a swing trader, and when he sees, his idea is basically that if he sees an A+ setup, he's going to go in heavy on it, right? And he's going to be okay, because if he loses this trade, there's another challenge account that he can go and purchase, right? That's the biggest difference between kind of the personal capital versus funded capital, which
Yeah.
you basically have a stop out on the funded account, and you have a maximum amount that you can lose, which is how much you paid for the account, right?
Correct.
We're essentially getting free leverage. If it's a way that aggressive traders can view it. Now, I would not suggest this aggressive method to people that are less experienced, because you can't just bank on getting lucky one time, right? You just can't. Like, it's not reliable. The reason I think James is able to take this approach and Sauser was able to take this approach, I think Sauser was saying, it took him 3-4 years of trading to get to where he is today, and James has also a large amount of experience trading the markets, and James knows that his setups work. He knows that there will be a payout at the end of this, right? And we're going to now get into this second half of the strategy, James, which is when you get to that funded stage, right? The idea behind this aggressive approach is pass as quick as possible, get to the funded stage. How do you then approach the funded account? How do you adjust? Give us the details.
That's a good question, because you do adjust, right? So even on phase 2, I adjust as well. Then on phase 2, I'm not risking more than 2% per account, okay, per trade. And then once I get to funded, I think I've actually kept one of my FTMO accounts. I did lose it a couple months ago, but I kept it for like over 2.5 years. And I took some nice payouts from it. My tactic for that was literally just to make 1 or 2% per payout cycle, and then I'll take my payout, okay? So basically what I would say is, once you get to the funded account, I'm not risking anything more than 1%, maybe 2% if it's like a really nice setup and I really do enjoy it. And maybe I've got some other funded accounts and I can, have a little bit more leeway. If you've got like 6 funded accounts, you can risk maybe more on the one, but I'm really not risking more than 1% per trade on the funded stage, simply because I've done all this hard work. I've maybe failed 3 or 4 accounts before passing. Now I want to make sure that if I spent $1,000 to get this account, I want to make 10K plus in payouts from this account, because if I can do that 10 times a year, I'm going to make some really nice money,
Yeah, I love that. I think, that's a very reasonable approach, right? Like, when you get to that stage, you want to try and keep that account. I think that's probably the right approach to take. I think some traders actually get it backwards, right? Like, they get to the funded stage and they see stars in their eyes and they're like, oh, I got money now. Like, let's bet big. And, that there's a reason why, statistically speaking, the average funded account only lasts 22 days.
Yeah,
all right, guys. The average funded account lasts just 22 days, not even a month, guys. Most traders who get to the funded stage don't make it past 1 month. All right, and there's a reason for that, right? The greed starts to kick in, the risk management goes out the window, and you'll see pros like James, they're doing the opposite, right?
Yeah.
On the challenge phases, they're going
Not all the time.
systematically, right? They're going aggressive, and then when it comes to the funded account, boom, that risk gets dialed back. But you have to have the discipline to be able to do that. You can't get to the funded stage and just the only thing you think about is, if I win this trade, I could make $20,000. If that's the way you approach it, you are going to blow up that account, faster than anything, right? Like, you can see how someone has planned for an aggressive approach and scaling back that risk. He even said phase 2, starting to risk less, right? Because you're getting closer to the goal. And the goal
Great.
is to keep that funded account for as long as possible so that you can start to make and actually withdraw profits, because that's where it actually starts to count.
Correct.
Okay. So, James, another question here regarding this strategy is, do you have a number of bullets, let's say, capital wise, that you would invest into trading challenges? And let's say, maybe let's give a more concrete example. If someone were to say have $1,000, right? Let's say
Sure.
they got some Christmas money and they have $1,000 and like, oh, I want to
Nice.
use this to try to break into prop trading, maybe make some payouts this year, right?
Sure.
How would you distribute, if you had $1,000 to invest into, just purely prop accounts, trading? How would you invest it? How would you use it?
First of all, I'd find a reputable firm like Hydra, right? That's the first thing I'll do. I'll do my research, find a reputable firm that suits how you want to trade. Then the second one essentially is, what type of accounts do you prefer? At Hydra, there's crypto accounts, right? Are you a crypto trader? Then there's also a 2-step and a 1-step of trading account. I've mentioned that for the more aggressive approach, you probably want to do the 2-step. It's got more drawdowns. For the more conservative approach, you probably want to do the 1-step. I've mentioned that too at the start of this podcast. So I think that's the first thing. And the second thing is, I wouldn't risk it all on one account. I would probably buy like a 10K account first to get. It depends if you are a seasoned trader already, but you haven't taken any prop firm challenges. Take a 10K account. I don't know what that is at Hydra, probably like $60, $70, whatever it is. Get a 10K account, get some feeler in the game with how everything works, with the rules. Because I see a lot of traders are like, oh, I'm doing well on my personal account, let me just go trade prop firm. I'm like, dude, on your personal account, you're drawing down like 10% in a day. You'll fail on the prop firm. Prop firm trading and personal capital trading is so different. You can be a bit more aggressive with the drawdown limits on personal accounts. So get a feel in the game with a 10K account. Then maybe bump that up to 25K or whatever you're comfortable. Let's say your goal was to get funded in the next 3 months, whatever it is, with $100,000 worth of challenges, with a prop firm capital, right? I would definitely split that up. So let's just say four 25K accounts. That's what I would do. So, and I'll try them one at a time. Either pass and fail them, move on to the next one, depending on if you want to take this more aggressive approach. But that's what I would do if you had $1,000 Christmas money to be like, I want to break into this prop firm game. I want to give myself more chances, and rather just buying a straight up $1,000 into one 200K account, I would give yourself more opportunities, get a feel level with a 10K account, and then build up from there.
Yep. I can share on my screen right here. So we could even do a detailed breakdown here. If you had $1,000, right, as James recommended, you're looking at the 2-phase plans. If you start off with a 10K account, that's $110 to start with, right? You would still be able to go ahead and purchase another 4 25K accounts after that. So if you start off with a feeler, right, maybe you're new to prop trading, or maybe you're trying out a new prop firm that you're not 100% sure on what the trading conditions are. Starting small is always better than going balls deep right from the start. I do not recommend going balls deep. Like, I run this term, and I would say if it's your first time trading prop, don't go after a big account. Okay, start small. Get a feel, get an understanding of how the trading platform works, the system works, how the liquidity is, what the spreads are, right? Because it's going to change and differ from firm to firm. So if you go ahead and purchase this at $110, right, you still have an additional $890 left behind from your $1,000 Christmas money. And that equates to another 4 potential challenges on the 25K. And I think I agree with James here. I wouldn't go even past the 25K account. Maybe you get funded on one. That's a different story. But just assuming that I only have $1,000 to spend, that's 4 shots at a 25K, and then that's when you can get aggressive, right? Maybe you fail the 10K and you go after a 25K. You're like, I like the platform. I like how their trading environment is, so on and so forth. Get a 25K. You also blow that one, right? You still have another 2 bullets left in the bag. And if you then decide, hey, actually, I want to scale back on the risk a bit. Maybe I want to take a conservative approach. You still can. The best thing about this is you still have more than 50% of your capital remaining. Actually, you have like more than 60% of your capital remaining from your $1,000 potential investment, right? This is how the prop firm game can be played. You can use it step by step. It's not like a broker where if you have $1,000 you want to invest in a trading, you're probably just going to put it all into a broker, and either you're going to blow it up and lose it all on over leveraging, or you're going to make a ton of money. Like, you don't know, right? But that $1,000 can essentially be leveraged using prop capital to go
Yes.
much further. If, let's say, you have a good streak, let's say, you start off the year really hot. Maybe you lose a 10K, but you pass all three of the 25, pass three of the 25Ks and you fail one, right? You now are managing $75,000 in assets, right? You've taken that $1,000 and you've turned it into 75K worth of capital to play with. Now, again, obviously that 75K is not yours. There's drawdown limits to it, but it's still capital that you can use to deploy, right? So if you,
Yep.
let's say, make, on the year, you end up, having a good year over 75K, you don't acquire more capital, you make a solid, let's say 30%, 40% on the year, right? With this 75K of
Right.
capital, you've essentially flipped your 1K several times over, right? Let's say you make a conservative 30% over the year. Okay, you did pretty good, not astronomical, right? Just had a pretty good year. 30% of 75K is going to be roughly $23,000, right? So you've 23x'd your starting capital, right?
Yep.
And all
You weren't going to do that in a broker.
yeah, you're not depositing $1,000 and 24xing it without risking it all blowing up.
On one
While
trade. Yep.
trading on prop, you can be trading under proper parameters, right? So this is kind of even within the aggressive approach, James, I think there is nuance to it, right? There's
Yes.
aggressive at the right parts and then scaling back and knowing when and how to manage risk.
You have to have a
when it's
plan.
necessary.
You have to have a plan with what you're going to do. Exactly what DY and I have just shown you here about what accounts to actually look for in that. You have to have a plan with what you're going to do, not just like, oh, I just got $1,000, because especially like in South Africa, that's a lot of money, bro. Like, especially if you're in a third world country, not just being like, oh, well, I'm just going to buy a 200K account because it's the biggest one. Have a plan. And I definitely think I could have probably done this a little bit better into my early days of my prop firm journey is instead of buying 200K accounts, I probably could have bought, I probably could have bought like four 50K accounts. And also something that I've actually made a rule on, and I made this rule about 3 or 4 months ago, is at a time, I'm never trading, for me personally at least, I'm never trading with more, because I use a copy trader across my personal and prop firm and funded and whatever. I'm never trading with more than $200,000 in live funded capital, right? Just speaking prop firms at the moment. And I'm never trading with more than 200K in challenges, because I don't want, if you have a winning trade, whoop-de-doo, you're going to make a lot of money or you're going to pass a lot of challenges. But if you lose, you're getting kicked in the nuts, bro. And it's not going to be pleasant when you do have that losing spell. So that's the rule that I made. Like, I'm never going to buy 600K worth of challenges and then trade them all at the same time. I've set my limit to 200K max. That's just personally what I've done.
I think that's some very, very solid advice, right? So you guys have seen now the aggressive approach where a trader, on the surface, if we just give you the soundbite of, oh, James is risking 2 to 4% on his challenge, that's not the whole story. Because the reason why I wanted to discuss this topic today is because we've kind of discussed this briefly on top, and I wanted to do a deep dive because I feel like it's unfair to just leave that out there and be like, hey, be super aggressive on your challenges, risk, 2%, 4% per trade. But that's not the whole story, right? Today we're able to give you the entire strategy behind this more aggressive approach, and you will see that it's actually very, very nuanced, right? How much capital do you have to deploy? How many shots? How are you distributing that across, different challenges? How are you managing your overall investment amount? And how are you deploying this capital in a smart way, right? James isn't just here saying, hey, I have $1,000, I'm buying a 200K account, I'm risking 2 to 4%.
Yeah.
That's dumb. No good trader is going to actually do that. You can be aggressive, but you can also be very smart in how aggressive you are.
Yes.
So I guess the key takeaways here are be very, very aggressive in phase one. Right. Well, firstly, split up your capital, know how you're going to deploy it across different accounts, right? And then secondly, in phase one, be ultra aggressive, right? Because that's kind of the early stages. You want to kind of either pass or fail quickly. Start to scale back in phase two. Maybe if you're doing 2 to 4% in phase one, phase two, profit targets lower, right? You're closer to passing, maybe scale that down to 2%. And then when you get to the funded stage, the goal is to keep this account alive, because if you stay alive, you get a chance to make money.
And just to reiterate on this again, is that I think something that I got caught up a lot in is that because I trade personal capital, and that's prop firms are not a track record. You're not trying to. I think something that I got caught up is like, oh, if I because obviously social media presence and everything like that. It's like, if I fail a prop firm account, I'm going to look like a loser. And like, dude, you're not building a track record with a prop firm. Build a track record with a personal account, show that percentage gain or whatever loss at the end of the year. That's your track record account. That's what you should be showing, because that's what investors are going to take more seriously. Prop firms are for you to leverage and make money. If I pass one account out of 5, like now with Hydro, if I do that and I get a 10K payout, well, I've made money. So that's the only thing that really counts at the end of the day. Now, I'm not saying go and put it all in red and black on every single trade and just spin it until you pass. No, I'm saying have a plan, be smart about it. But prop firms are not to build track records. They to make money.
That is some very, very solid advice. And I think that anybody who is looking to get into prop firms, you should be seriously considering taking out your payouts and putting them into a personal account and growing that.
Yes.
Because when you are trading prop firms, and I'm not afraid to say this, right? Like, you are taking a risk on another person running their company. You don't know whether this company is going to be around in a year, 2 years, 3 years, 5 years, right? Like, you hope they will be, but you are taking a risk on somebody else, right? It's better to take a risk on yourself. Again, there's also risk on brokers, but probably a lot less risk than if you're using a reputable broker than, let's say, a prop firm going down, right? So, I think these are all very key points to kind of take away. And I think if you are a seasoned, more aggressive trader, that you are very certain that over the course of a certain number of challenges, you are going to come out profitable. I think that aggressive approach that, James has just outlined for you guys is a very, very good way to approach it. And you are in here, you are in the prop game to make money and get payouts, right? What I'm going to present to you now is going to be a little bit of the flip side scenario. And this is probably more applicable to traders that are newer, right? If you are newer, testing out a new strategy, maybe not so certain about yourself, and you don't really want to go through the psychological turmoil of, blowing up accounts, because let's be real, right? No one likes to lose, right? Losing is not a great feeling. Breaching an account is not a great feeling, right? Even for James, someone who's seasoned, who's been trading personal capital, prop.
I hate losing.
Yeah, no one likes it, right? It's never a fun time when you see that you've breached an account. So if you are maybe looking for a little bit less variance, right? Like a little bit less risk. Maybe you have even less capital to start with, right? Maybe you just have a couple $100, or and you don't mind, you're trying to get into trading. You don't mind taking a little bit longer to figure things out. I think that prop accounts are a great way to segue yourself into full-time trading or into managing larger amounts of capital. And I think that you can take a much more conservative approach here, which I want to present to you a more kind of like gamified way of doing this. And I'm going to allude to how I used to take shots in poker and move up in levels.
Sure.
Right. And, the most basic conservative approach, is just scaling back on risk a lot. And you can trade a 1 phase, 2 phase, it doesn't matter. You can risk anywhere from between 0.2 to 0.5% per trade. Okay. And I think that, that as a baseline is going to ensure that you're able to trade for a long time. Now, why would you want to trade for a long time? Number one, maybe you are looking to forward test or collect data on your trading strategy. Maybe you don't have that much experience executing on the live markets. Maybe you just joined ASFX and you're starting to learn the way that they trade, right? You're starting to follow James, you're seeing his setups, but you're not 100% confident. You don't have the data. And especially in discretionary trading, you need to build up that sample size. You need to start to execute for you to be able to see the plays before they happen, participate when it's there, not be afraid to click the buttons. A lot of these things that beginner traders really, you just need to put in the hours and the time to go through. And I think prop capital and trading prop accounts is a great way to have skin in the game, right? Because when you're trading just a demo account, you know that it's just nothing is there's nothing on the line, right? It's a
Yeah.
very big difference when there is something on the line. I think trading a small prop account using small percentage risk is a way for you to be able to get that feeling of like, ooh, there's something on the line, right? Like if you've ever traded demo funds, you know that there's a difference from trading that to even a prop account to even live capital, your own money. So, you know, taking this like 0.2 to 0.5% risk approach ensures that you're able to get in as many reps as possible. This is the first group of people that I would strongly recommend low risk to. You are looking to get reps in. You are looking to forward test and collect data on your strategy on the live markets, right? Use prop accounts as a way to do that because you will be able to replicate that skin in the game feeling without putting it all on the line. So very beginner friendly strategy, very straightforward, very simple. Now, if you want to take this a little bit more gamified, a little bit more complex way of approaching it, but a little bit more fun, maybe for me, you know, I
Yeah.
like it, is you can play with what I call scalable risk based on the progress of your account, right? So let's say we start, you know, everything at zero. You have a 100K account, you know, you're just starting out, you risk 0.5% per trade, right? And you take it by levels. You say, hey, if I draw down the account by $1,000, right? If I draw down the account by 1%, I scale back the risk by 0.1%. So then I go to 0.4% risk, right? So if you are losing, if you're enduring a losing streak, this way you allow the preservation of the account by going smaller on risk as you go into drawdown so that you minimize the impact of losing streaks. In poker, a lot of times when I'm having a bad month or when you know, a lot of other pros that I've played with had a bad month, we would go down in stakes, right? We
Yeah.
would go down in stakes. And in poker, this is maybe a little bit more significant because the lower stakes tend to have easier players to play against. It's not necessarily true of trading, but there is still the psychological benefit of enduring a losing streak without seeing the numbers being so volatile, right? There's a big psychological benefits to why you would choose to move down for a particular month and maybe play at one stake lower or even two stakes lower because you just want to get over this losing streak. Maybe you're running bad. Maybe you're frustrated, right? You scale back the number of tables you play and you go down in stakes, and then everything starts to even itself out. So you can start to scale down as you go more into drawdown for great benefit psychologically and also preservation of the account. It ensures that you are able to continue your data collection for a longer period of time, right? Because maybe for data collection, you want 100, 200, 300 trades on your record. And you don't really want to have to run through 3, 4 challenge accounts unnecessarily on a strategy that, you know, you're maybe new to trading or you're uncertain about, right? You don't really, you're not really looking to, you're not even sure if this is going to make you money. So why would you just continuously dump money into it, right? So if you want to preserve capital, preserve that account, you can scale back. Now, conversely, on the positive side, if you start to make money, if you start to go into profit, maybe after you make 1% profit, you scale that risk up to 0.6, right? And then if you're in 2% profit, you scale that risk up to 0.7. That's one way to do it. Another way to do it, which I personally really like this way, and I think this is, I don't think I've heard anyone ever talk about this in terms of like prop trading, which is if you win a trade, right? Let's say you win a trade on, you know, your first trade and you made, I don't know, let's say you're risking 0.5%, you made 2 RR, you made 1% profit. You take that 1% profit and you use it for your next trade, right? You
Yeah.
use it as a
Because,
shot take.
yeah.
It's the same thing that we do for poker. You can do it
Yes.
in any kind of way. I'm just giving a very simplified way. I'll tell you exactly how we do it in poker. For example, in poker, if you are playing a certain stake, let's say you have $10,000 in your bankroll and you want to move up a stake, and in that month you've made a 20% gain on your bankroll. You have now $2,000. You wouldn't risk the whole $10,000 on the next level because the volatility kicks up, the difficulty kicks up. You just use that $2,000 that you made as a shot take, right? You say, hey,
Yeah.
if I go and play these $2,000 and I lose it, I'm back to my original stake where I'm very comfortable. I know that I can continue to make money here and I can build that up. But I want to take a shot at the next level. I want to see if I can get there. Right. So you can do the same thing when it comes to trading this prop challenge, right? Preserve your account and capital when you are in drawdown and then get more aggressive as you are in profits. It's almost like scaling into a trade, right? Which you know, day traders talk about a lot.
Yeah, just a quick one, DY. Explain how that mindset of like doubling the risk, you're doubling down essentially, because now you can't get married to the profits. You have to if you lose, you're back to break even.
Yeah.
Correct. Yeah.
So the mindset here really is that, you still want to try to pass this as quickly as possible, but we're taking a little bit more of a nuanced approach, meaning we are trying to keep the account alive for as long as possible while still being able to be aggressive. Now, again, if your goal is really just data collection, don't do this, right? Just keep your risk static, collect your data, and then maybe when you are more confident, when you have 100 trades, 200 trades worth of data, you're profitable, start to scale up. But if you want to play this game and you still want to be like, hey, like I want to feel like I want to really move aggressively towards passing this without taking too much of a risk, this is how I would recommend it. Is a very safe way. You want to trade, right? You made profits. Again, why don't you take this profit and double down on the risk, right? Because if you have that 1%, right, and you win 2 trades in a row, you take your next setup, it's great. You win another 2 RR, right? All of a sudden, you're up 3% on the account, right? And then if you can then roll that again. You can then roll that again into the next trade, right? If you want. It really depends on you how aggressive you want to get with this. Maybe you want to build a bigger buffer for your shot taking amount, right? Like let's say the total profit target is 9% on 100K, which is $9,000. Maybe you want to build up a buffer of like, let's say $3,000 and then split that up into, I want to take the next 2 trades, $1,500 risk, 1.5%, right? It
Sure.
really depends on you how you want to take it. But the whole idea behind this is build a buffer and then use that buffer as a shot take, as almost like a springboard to get you to passing it faster. Because let's say you've built up let's say you built up $4,000 in profit and you're like, ooh, I'm almost halfway there. If you split that up into 2 trades of 2% each, right, you're essentially doing what James is doing, which is risking 2 to 4%, right? But you're already up 4%, so you're not in any danger of failing or breaching the challenge. Right? If you do lose that amount, you have a strategy to help you preserve that account, but you're using your profits, right? If you risk a total of 4% on a 2RR setups, right?
Yeah.
You're passing the challenge within the next 2 trades, right? While all the time being in a more conservative approach. But it's about when, right? So this strategy or this approach is really about when to put your foot down on the gas, and you just have to be okay with coming back down to break even, which is a lot less psychologically, let's say, intimidating or demanding than blowing up an account and having to pay for another challenge, right?
Sure.
So I've kind of presented to you guys a little case of like, hey, the very basic, slow grind approach is just like, static risk, anywhere from 0.2 to 0.5%. You just collect data, right? Build up your reps. Don't scale up that way if you are new. If you are new and you're starting to gain confidence, you're like, cool, I'm ready. I feel like I can, go hard and pass the challenge. I've collected 100 trades worth of data. I'm up about 3% on the account. I think it's time to get aggressive. Do that. Do the shot taking method that we used in poker. It's the same thing. I grinded my way up from playing $10 buy-in games to playing $200 buy-in games on poker. And I started from playing 2 tables to 12 tabling $200 buy-in games. I started from playing 2 tables of $10 to
Jeez.
12 tables of $200 buy-in games in poker, all using this method. And you can just do the math very easily, right? $200 buy-ins, 12 tables, that's $2,400 at risk at any one given time, compared to $20 at risk at any given time.
Yeah.
But that was how I built my bankroll over the course of my 2 years
That's,
basically playing full time. Is I just used this shot taking method. I kept taking shots. Sometimes they would fail. Sometimes it just worked. You ran good. You
yeah.
very quickly multiply that capital, and all of a sudden you're like, oh cool, I'm just playing at the $50 stake. Oh cool, I'm just playing at the $100 stake. You start to double down very quickly. And the thing about this is you get to double down on momentum, and you slow down when that tide is turning against you,
Yes.
right? It's
Yes.
variable. So you're able to kind of control that slider, that knob, and you're kind of fine tuning your risk as you are making more. You turn that tap, you want the water to run faster, right? But
Yeah.
if the water's coming out shitty, muddy, gross, dirty water, you're like, no, I'm not, I don't want this,
Oh,
like
oh,
maybe turn off the tap a little bit, right? So that's kind of my, that's a little bit of like my approach, like my suggestion for more beginner traders who are a little bit unsure, right, I think this is a very good approach to risk management that will probably have you feeling a little bit more psychologically even keeled and a little bit more calm during your trading process, but still allows you to turn it up if you need, right? But turn it up in a very, very safe way. And once again, I kind of want to iterate on who this strategy is for. It's for a very different group of people than, someone like James, someone who's
Yeah,
very confident in his strategy, knows he's going to make money, has made payouts in the past, has experience, right? This is for someone that's a little bit unsure, a little bit newer to the game, right? Wants
sure.
to take things slow, wants to collect data, wants to just feel things out a little bit. Take this approach and don't rush, right? The biggest thing about this is if you are new, be very, very patient. Don't go for the biggest accounts, go for smaller accounts. Don't rush for big trade sizes. Don't try to pass as quickly as possible because you're probably just going to end up blowing multiple accounts and wanting to quit or running out of capital. People think that, oh, like, it's just trade, I can buy another. No one has unlimited number of tries. If you
No.
are a terrible trader and you don't have a winning strategy and you don't have an edge, you are just going to blow accounts over and over again. It's not out of the question for you to lose 20 accounts in a row. I've
No,
heard definitely of people that lose 20 accounts in a row. You don't want to be one of those people, okay? If you
I agree.
are new, take that patience, eat some humble pie, right? Like just be like, cool, I don't need to be $1 million funded trader this year, right? If I
Yeah,
can solidify my strategy, start collecting some stats on TradeZilla, same way that James does, analyze the data, take a very non-results based thinking is going to help you here. Don't let the money get to you, right? Non-results based thinking, don't base yourself on results. Try to gain that experience and try to collect that data, and that's going to help you get to a place where you can then maybe start to get more aggressive. Maybe you use this more conservative approach and you pass your first challenge.
yeah,
Maybe then that's when you're like, okay, cool. I kind of get it now. I want to deploy more capital towards prop trading. I want to start to accumulate. Then you jump onto the more aggressive approach because you now have 100 trades worth of data,
yes.
right? You are more confident in your approach. And you're like, cool, I'm okay if I just pass one out of the next 4 challenges because I'm pretty sure I'm going to make money, right? So
Yep.
again, these two strategies that we've introduced to you guys today are not really mutually exclusive to each other. You can go from one to the other, but I think there's a general trend. Don't I definitely see a lot of traders out there talking about like, oh, big risk. I passed my FTMO in 1 day, 2 days. But if you are passing in 1, 2 days, you're taking pretty big risk, right?
Of
And
course.
I don't
Yeah.
really want traders out there to we get a lot of sound bites, James. This is trading industry. Twitter is all about these
Yeah.
fucking sound bites, right? It's oh
Yeah.
yeah,
It
this
is.
guy. I saw this guy. He passed 100K account in two
Mhm.
days. Like, why can't I do that? There's more. You're seeing the tip of the iceberg. If James says, "Hey,
Yeah.
I passed my Hydra challenge. I traded. I took only 8 trades and I passed my Hydra challenge." You'd be
Yeah.
like,
But
"Oh shit!" Like, well, if I do the math, like, but you don't know everything that he's just shared with you guys today, right?
yeah.
How he's
Also, that I
pushing the engine.
failed 5 previous times. So yeah.
Exactly. And it was all planned. It was part of the plan. That's the biggest thing. Is he understands the risk that he's taking. He understands his approach. It's worked for him before and he's confident he's going to come out profitable at the end of the day, right? If you don't have any of that, you go into doing what he does, you're asking for it. Like you're asking to run out of capital and blow up accounts and run out of confidence, right? So yeah, I think that's kind of a wrap on my side, taking into account this more conservative approach. Let's call it the shot taking method, right? So I think today we've presented to you guys two quite different approaches to prop trading and risk management in prop trading. James, do you have any finishing words to words of advice to lead to the viewers based on what we've talked about today?
No, I think you choose a way that you're going to do it. I think the worst thing to do is be in between. Be in between about being more conservative and aggressive. Choose one. Are you going to be conservative? Do that. If you're going to be aggressive, do that. But have a plan and then stick to that plan until you either pass or fail, and then you can readjust the plan. If something's not working, if something's not working, you can always step back, look at your stats, see what you need to do, see where you're at, and readjust. I think that's the best thing that we actually as retail traders can do. We can do things based on how we would want to do it. So yeah, come into it with a plan and then stick to that plan. If it's not working, adjust. You're always making adjustments as traders. So yeah, I'm looking forward to 2025. And yeah, I think that's going to be great. With podcast, with the trading, going to share a lot more stuff in the new year. Yeah, I'm doing some stocks next year. TY is doing obviously the swing trading. So there's going to be a lot of stuff to discuss on this podcast come the new year.
Yeah, I think that there's going to be a lot of exciting things coming up in 2025. James obviously is still going to be covering the day trading, scalping side of things. He's going to be talking about stocks, indices, and my main thing is I'm now mainly just swing trading currencies. Like currencies have been performing extremely well for me. I've had a great month in December, currently on a little bit of a break, but really looking forward to bringing more insights to you guys, more strategies, more in-depth talks. And if you have any questions or if you have topics that you want us to cover, leave them down in the comment section below. And please don't forget to give us a thumbs up if you enjoyed this episode and you want more from us. Let us know, and we'll see you in the next episode. Peace.